In this webinar, we're going to be discussing the psychology of successful investing and how the emotions, biases, and decision makings around investments work. A quick disclaimer before we begin. So this webinar provides general information only, and what that means is it does not consider your objectives, financial situation, or needs, and accordingly should always consider the appropriateness of invitation. The information presented is not an invitation to invest, nor is it a recommendation to buy or sell investments. And as always, we recommend that you seek independent advice and fully ensure you understand risks before trading and investing. My name is James Woods, and I'm a portfolio manager here at Rivkin. A quick outline for you. So firstly, we'll give a little bit of an introduction around what is investor psychology and talk a little bit about behavioral finance. A little bit of an understanding on what these emotional biases are that we're talking about. Some of the common cognitive biases that are present in investing and a few examples to go along with that. And some case studies and how can we overcome these biases? What strategies can we use? And then we always reserve some time at the end for some questions. A quick reminder that this webinar is recorded, so if for any reason you've entered late or that you need to leave early, don't worry, we will send out a copy of the recording to you at the end. Additionally, if you could please keep an eye out for our post-webinar survey. We take that feedback on board and really helps us in determining what types of topics and the way we present these webinars. So really appreciate any feedback there as well. So starting out, what is investor psychology? Really, it's this emotional and cognitive factors that dictate our investment choices. And they're not always a bad thing, these biases. They're the reason we're here, the reason why our ancestors and our relatives, and the reason we're all here is because we have these biases that meant that effectively our ancestors survived. But when it comes to investing and finances, they can often be pitfalls that lead to poor decision making. So really to help with this, the best way is typically a structured approach. If you don't have the mental discipline yourself, having a really process-orientated investment decision is a great way to deal with that. I will identify these key biases and understand a couple of real-world examples of I'm sure we can all relate to these biases. And then at the end, just covering some of those strategies that I mentioned on how we can deal with it. So understanding emotions, these influences when it comes to investments. So what is the role of this? Well, emotions guide perception and decision making, and they can also cloud our judgment. So they're a bit of a double-edged sword here. The point of this is not to eliminate emotion and say that emotion is a bad thing, but really just to be aware of it and manage it within our investment process. Markets often mirror our own emotions in cycles if we think about it. For example, if we've bought a stock, it's going up, it's doing very well, we feel we've made a great decision and we're really happy with ourselves. But as soon as that top stock starts to turn down, that's where we start to get a little bit worried, a little bit fearful, we're giving back some profits. And it's these emotional swings that we go through on a daily basis that can lead to impulsive decisions. And often impulsive decisions are rarely the right ones, particularly from a long-term perspective. Those emotional highs and lows are a part of every investor's journey. And some deal with it better on a discretionary basis, and others are more process-driven in how they deal with it. So trying to be aware of those emotions and detach from them is crucial in terms of remaining rational and objective. You often hear when it comes to investing, when it comes to the stock market, that it's assumed all investors are rational and the market is very efficient at pricing things. That is certainly relevant, but it's not always the case. And we do see bubble mania pop up in markets. We've seen that over the centuries. If we look back at the dot-com bubble or the Bitcoin bubble, post-COVID, we look at the tulip bubble, there's countless examples of this. So just something to be aware of, that the market isn't always efficiently pricing things. The highs and lows, as I mentioned, those market cycles of a bull market and a bear market typically correlate with those emotional feelings that we have. And market timing is certainly influenced and really can lead to suboptimal entry and exits. And what we mean by that is typically buying a stock near the highs. I'm sure we can all relate to that, where you've bought a stock and at that point it just starts to turn lower. Or by the time you finally decide you've had enough and it's time to get rid of that losing stock, that it shortly bottoms and begins to move higher. So just something to keep an eye on. A couple of real world examples, as I touched on, Bitcoin, we saw that go exponential. It was the new thing. It was going to go to $1 million, and there's a lot of people underwater on that. We saw the COVID bubble in speculative stocks, non-profitable stocks as well. The dot-com, depending how long you've been investing, this may be relevant for you or not, but certainly lessons can be learned there. We saw exuberance lead to risky investments in technology stocks. Again, many that weren't profitable. This was a time where many companies that had nothing to do with the internet would simply add a .com to their name and become the next hype stock and easily able to raise capital. It's not always about bubbles either, because fear is the other side of this. When we look back at what happened with the invasion in Ukraine, there was a lot of fear and a lot of headlines around this, and understandably so. We saw a sharp sell-off in risk assets, in the stock market particularly, and investors move into these safe haven assets. But that move was very quickly reversed, and we see countless similar situations historically. And a more recent example would be this fear of rising interest rates amid higher inflation would lead to a crash in the housing market or a severe recession, just given the levels of debt we have. And it's not to say that that won't come true, but so far those concerns have certainly been a little bit overhyped. So what are our cognitive biases that we're talking about? We say errors. They're not a bad thing because they are the reason we're here, but they're factors that can significantly influence your financial decisions. And really what they are mental shortcuts to allow you to quickly make decisions. And as I say, not all biases are bad. If we think about fear and aversion to risk, if we think back to the time of our ancestors, and you have two people and they see an object in the distance, one thinks it's a rock and it's safe to go over, and the other thinks it might be a lion because they're a little more risk adverse and they don't want to go over there. What happens is the person who's more risk adverse stays away. The person who goes over there turns out to be a lion and gets eaten. Well, that's the end of their line. So, these are the biases we're talking about. It's ingrained in us as humans. So awareness is crucial when it comes to managing our finances. Understanding and being aware of these biases can lead to better decisions and therefore your financial well-being. By not dealing with these biases, you can lead to irrational decisions, herd mentality, and financial losses as well. So some of the ones that we'll be touching on are the most common. This includes framing, herding, hindsight bias, loss aversion, overconfidence, recency, anchoring, availability, confirmation, and the disposition effect. And a lot of these are related and linked to each other as well and have a lot of crossover, but we'll talk about them in more detail now. So the first is framing bias. And in the simplest sense, it's how information is presented to us. So if we think about a situation, if I came to you and I said, how would you react? I'm going to pitch you two investments. Investment A has a 90% probability of success, while investment B has a 10% likelihood that it loses money. Okay? The odds are actually the same, but how we present this information in this question influences how people react. And typically, people are going to go with investment A because 90% probability of success sounds better. So this is systematic, error that occurs in this shortcut, and even though they have the same probability of success, and option B might be better for us, we're quick to go to option A. And that plays a role in our asset allocation, in our risk evaluations, and how we assess performance. So, the impact on this is it can lead to poor asset allocation decisions. The framing of news can really influence our buying decisions. Financial news is great for telling you what has just happened or what is happening at this moment in time, but it's not telling you what's going to happen. And markets are very forward-looking. Investors are always trying to price in what's happening 6 or 12 months from now. And when you see sensational headlines, it can really stir up these emotions in you and cause you to make an irrational, quick decision. The next one is herding. And this is something we at Rivkin deal with a lot because one of the investment factors we use is a momentum-based factor, and really one of the the attributes of momentum investing, which is essentially buying things that are going up and selling things that are going down, is to try and capture this herding behavior. Is the tendency for crowds in investment decisions. So, we typically might get caught up in the hype of everyone's doing this, everyone's making money out of this, I can't miss out, even though our own personal analysis might say that it's not a good investment decision. And this stems from the early days as hunters and gatherers. And the reason is sticking with a group typically ensured your safety and survival. And that's why we have this mentality and this herding that happens in markets. And as it builds over time and generates more hype, that leads to more hype and more herding, and it becomes a self-fulfilling cycle. And that's how we see bubbles created and an increase in volatility. Now, while that's great, safety in numbers in real life might be really beneficial for us, it's not always great when it comes to investing. So it can lead to popular stocks becoming overvalued and overhyped. And the trick with herding, if you are going to get caught up in this, is knowing when to get in and knowing that, okay, it's time to get out when things have continued or are starting to turn, and not holding on for those for too long. And typically this herding certainly leads to market manipulations in some markets, and lack of diversification, because we get caught up in one investment that's going hot and we put too much money into it, so we're increasing our risk there. And a really good example of this was the GameStop frenzy that occurred in the United States. Essentially a company which was likely to go bankrupt, and many hedge funds were shorting it. However, it created this social media hype, particularly on Reddit, that led to this massive buy-in from retail investors, particularly using leverage and call options and other derivatives. And the result was, in a very short period of time, there was a squeeze on the stock, which caused it to soar. And then once that bubble burst, it crashed rapidly. And this is what that looked like. So you can imagine some of the hype that was going on here in early 2021 with people making these stories, particularly on social media, very prevalent in our mind. However, a lot of those people that effectively bought and held are now significantly underwater. So that's what we can see in terms of herding with some of these bubbles. Hindsight bias. This is an interesting one. Hindsight is 2020, and it's not just when it comes to financial investing. We typically see this in our everyday lives as well. And effectively, it's where we view events as being after the fact more predictable than they were with the information we had at that point in time. Believing that these past events were actually more predictable than they really were at the point in time can lead to overconfidence, which is another bias we'll touch on in a little bit. And effectively, it gives us overconfidence by looking back at something and saying, well, I would have seen the global financial crisis coming. I wouldn't have lost money in that. And, really gives this overconfidence in our decision-making ability. And therefore, we can tend to take more risk than we're actually comfortable with as a result of that, and misjudge market trends and underestimate those risks. So, another example, other than the GFC, more recent, would be this period of heightened inflation that we've had post-COVID. And, over the last 18 months following financial markets, I'm constantly seeing revisions to projections, constantly to a higher peak in interest rates and a repricing of interest rate cuts to no cuts. So it's evolving, it's constantly changing. And we are updating things with the information we have at the point in time that it's occurring, but looking back, it's much more obvious to us. And what I'm showing here is just to show this progression is the change in forward interest rate expectations in the United States. And we effectively start out at the bottom here, and we can see that this has just moved up and moved up and moved up constantly. Even, these long run expectations don't move that much. We can see, particularly at the short end, that it's moving up on a constant revision. Next is loss aversion. And, this is one I'm sure we can all relate to. I know I certainly do. And if we think about this, making if you invest $100 and you make a $100 return, you feel pretty good about yourself. But if you lose that $100, you feel significantly worse than the joy you would have felt from making a profit. And it's this risk-adverse nature that really can compel investors to either take high risks when they're holding losses in their portfolio, or not exiting an investment when they should and they know they should, because they don't want to crystallize that loss and confirm that they were wrong. And as investors, no one is right 100% of the time. So you need to be aware of this and embrace it. Take the loss. There's always more opportunities out there. It is important to balance that fear of loss with making rational investment decisions. And, again, it really comes from this safeguard desire, this protect what we have. We often buy something, and this ties in with anchoring, and we'll touch on that later. If we buy something at $100 and then it's trading at $50, and in our mind it's still worth $100, we don't want to sell that because we don't want to take the loss on our hard-earned money. And as part of this, we tend to sell, and it also ties in with disposition effect. Is this tendency to sell winners too early, because locking in that gain makes us feel really smart, really happy with ourselves. We've made the money. But holding on to a loss, and quite often we say, or people feel, I haven't made a loss until I sell it. But the reality is, if something goes from $100 to $50, it's currently worth $50, if that's what someone's willing to pay for it today. So that loss is there, you just haven't sold it. And again, it can really result in poor decisions. It can see a big increase in the frequency of trading, which results in higher costs, which can hurt us over the long run as well. And, again, I'm sure we've all experienced this. We buy a stock price is falling, we're thinking it's getting cheaper, coming up with a narrative that it should turn around, and we're hoping that it will. We might even start to put more money into it in terms of dollar cost averaging, but we effectively just amplify our losses. And a really good example of this would be, in the US in March this year, we saw the collapse of several regional banks. Signature Bank New York was one of them. And you could understand the case where this traded a little over $350 and then started to decline. A lot of investors might have thought, hey, this isn't rational. I really like the stock. I'm going to put more money in, or I'm going to continue to hold. And in other cases, that might prove true. I mean, we've got hindsight bias on this. But you can understand where people would hold this stock all the way down, thinking that there's going to be a turnaround, and then suddenly in March 2023, the bank collapses and the valuation goes to zero. Next, overconfidence. We touched on this a little bit earlier, and who's not guilty of this? I mean, there's this often quoted thing that 90% of drivers believe they're in the top 50% of drivers. We can't all be, but we're all quite confident in our abilities. So it's this mistaken belief in our own ability that we typically are better at something than we might be. It's not a bad thing, but you need to be aware of it, because if it's unchecked, it can be dangerous, and it can lead us to overlooking risks and taking excess leverage or excess risk in our investment. And on the back of that, we do typically also see a frequent increase in the frequency of trading as we try and time the market. We're so smart, we can pick the highs and the lows. The reality is that no one has a crystal ball. We don't know what's going to happen. And as part of this, we can often neglect external advice and warnings as well from experts in the industry, because we are confident in ourselves, and maybe we've had some success in recent investing, and that gives us that confidence. A lot of time is where people think, I can pick the next big thing. It's a super speculative stock, but it's going to grow 10,000% over the next few years. And that confidence makes us overlook other risks that might be associated with that stock. Recency bias. This one isn't always so obvious. This is where, if we look at information over the past month and it's all relevant, we tend to weight information that happened over the past week as being more relevant than information that happened over the past 3 weeks. So we're focusing on what's most recent, and this is that shortcut that we have in our mind. And that's our natural propensity, just to pick up on readily available information. And again, like most of these biases, one of the effects we see is high transaction costs and over trading. It's not to say that lots of short-term trading is a bad thing, but not many people are successful at it, and costs are a big part of that. We might be too focused on the short term and ignore those long-term trends. An example would be, if we look at on the back of COVID, a boom in biotechnology stocks. There was this worldwide pandemic, lots of headlines around it, lots of other biases influencing on this as well. And lots of investors swarmed towards biotechnology companies due to rising share prices, and they were in the news and their success in developing vaccines for COVID, and what would that mean for the future of solving illness going forward, but not really considering whether these companies had a sustainable business model and what the outlook would be for them post-COVID when this demand started to die down. And really, when that boom ended, you can understand those influenced by recency bias in this case would have faced significant losses. And what we're looking at here is the biotech ETF in the US. And you can see that surge all the way to the start of 2021 in these names. Moderna was a big one, Pfizer another one, and since then have come down dramatically. And this is where investors who, again, might have bought on the way up, you're experiencing loss aversion on the way down. You don't want to sell that. You don't want to crystallize that loss. Next is anchors. And again, like most of these, they are similar and related to each other. And this is where we anchor on a specific price, like the entry price of an investment or the exit price, or the stock's all-time high or all-time low. And by anchoring to this price, we're tying our mindset to it. And the saying is, it's very simple and it sounds very simple: buy low, sell high. It's very common in the stock market, but it's actually difficult to do. And how do we define what high or low is, in the market and for us? So as a result, as in the example I gave earlier, if you buy something for $100 and it drops to 50, you've anchored that that stock is worth $100 because you bought it for that. But the reality is the stock is worth whatever someone's willing to buy it at this point in time. And therefore you're reluctant to sell because you've anchored your price at what you paid for. And therefore you might be missing out on opportunities because you're waiting for that stock just to return back to where it was to get out. You might miss out on other opportunities. And cryptocurrency in the early 2020s was a good example. Many investors anchored their prices of these sky high valuations on digital currencies based on limitless growth potential, which has really since died down. And the market experiences substantial correctors, and numerous investors, again, loss aversion tied into this, but that have this anchoring to the price that they bought, are left underwater and still waiting to recover on those. And it's not always about buying or anchoring at a high price. Like with Bitcoin, sometimes it can be the opposite. Sometimes we avoid a stock because it's moving up too much. If we look at Nvidia at the end of 2014, this thing had risen multiples, and since then it's continued to go up. So investors that are constantly waiting to buy the dip miss out on some of these opportunities. So it affects us. How do we think about highs and lows? Availability bias. This is overestimating the importance of information that we can easily think of. Again, kind of tied in with recency bias. So recent news or vivid, really important events dominate the decision. And from the reason we have this is, the ability to make quick decisions in threatening environments really helped our ancestors, and that's why we have this. And it leads us to depend on what information immediately comes to mind and what's easily remembered, rather than a more exhaustive and longer process. And the impacts of this are, you typically see a reluctance to sell at a loss, again, tied in with anchoring, or you neglect broader data that's out there and focus on something you've just heard in the news because it's quicker, it's easier, we can make a decision now. And that hasty decision making, again, like most biases, leads to poor decisions, over trading, increased costs. So, if we think about a scenario where there's been an airline crash, investors are selling out airline stocks, and the share prices are falling. This is based on availability bias, but they might be ignoring, the industry's general strong safety record. And so we might be making a rash decision at that point in time. Next, again, it's not always so obvious, but it is a really important one, is confirmation bias. And we do this subconsciously. We look for information that confirms our view. So it leads to overconfidence and it reinforces poor judgments. And it's a defense mechanism. It protects us from the uncomfortable feeling we get, for something that says that our view was not correct. So it's very soothing to us to have our views and thoughts confirmed, and helps us maintain our understanding of the world. So confirmation bias, looking for information that supports our view, can lead us to ignore red flags or contrasting viewpoints, and really select data that just supports our investment, which it might be the wrong decision, might be a bad investment, but we're looking for data that supports it. And another one example would be, you buy a stock, share price is falling, and you're holding on to it because you keep reading articles about people who also like the stock and think it will go up, while you're ignoring research from other people that are saying, well, the outlook's not good for these reasons. And the final one is disposition effect. And again, kind of tied in with loss aversion. Tendency really just to sell assets that have increased in value, lock in that positive feeling, and keep assets that have dropped in value. As I said, it's related to loss aversion, so a loss hurts more than the good feeling we get from a gain. And holding on to a losing asset to ward off that confirmation of a loss and instill hope in a revival, it can lead to lower returns because we should hold on to our winners as long as possible and let the benefits of compounding happen. So we often see people prematurely selling winning stocks. Again, we only know that in hindsight. Have higher tax implications because of the frequency of trading, selling off booming tech stocks to lock in gains. As an example, Tesla has been touted many times over the years as overhyped and overvalued, and the share price has just continued to go higher. So if someone was motivated by this disposition effect, they would have missed out. And as an early investor and sell on initial gains, they would have missed out on all those gains that followed. So how can we deal with this? Self-awareness is being aware that these biases exist is the best place to start. So really, on a regular basis, assess your decision making. Before you make a decision, think about these biases and try to identify, are you being impacted by any of them? A lot of traders, a lot of investors keep a journal or some type of track record. So when they make an investment and they get to the end and they've either made or lost money, and now they're influenced by hindsight bias, they know information now that they didn't have then, they can reference back to that point in time when they made the decision with the information they had available at that point in time. And that helps frame things for us as well. Another way to deal with it is process-driven investing. We're very big on that here at Rivkin. We like to use a systematic approach to things. And that disciplined approach helps us avoid some of these biases and the noise. It doesn't mean that it's foolproof, because even if you have a rigorous process, you could still be affected by biases and not follow the process. But it does help. Diversification is a key one. So a balanced portfolio to help you mitigate those risks and those biased decisions. Having limits on how much exposure you can have with one stock or one sector prevents us from taking outsized risk. And finally, consulting third parties, whether it's a financial advisor, whether it's an automated investment platform, whether it's regular investments into ETFs, can really help be more objective in that decision-making process. And often talking to people as well. Talk to peers, talk to colleagues, talk to friends, talk to an advisor, get different views on things. When you're reading information, don't read it from just one source. Look at different things, try and find someone who has a contra view to it and understand their view and reconcile the two. Really dealing with these comes down to cognitive reframing, which is just challenging your perspective. Question your assumptions, question why you believe something, have a devil's advocate approach to things. As I said, robo-advising and algorithm-based decisions, or just a set process to follow, can really help us deal with them. And predefined rules as well. Doesn't mean it's infallible, but helps to reduce those impulsive decision makings. And again, periodically review your investment decisions, review your portfolio, and go back and read through a journal or your notes on how you felt with something at the time. So the takeaway points of this is this is just a high level. This isn't a course in behavioral finance, but just to introduce the topic to you. At the end of this, hopefully you now have an understanding of what behavioral biases are and how you can manage them. How you have awareness and active management are really key in dealing with these biases, and how you can benefit from a disciplined, rational approach. And if you want to go and try this for yourself, the next steps would be to go back, look at your past and your current portfolio, look at your decisions, see if you can identify some of these biases, implement some of the strategies we discussed, to help mitigate their impact. And learning, reading, always improving, self-improvement. As investors, the market is constantly evolving, situations are rapidly changing, and self-improvement is a really big part of that. Okay, that's the end of the webinar. We always leave some time at the end, so I'm just going to pause the audio for a moment and then see if any questions come through. Okay, it's been a few minutes now. We haven't had any questions come through, so hopefully that means I've done a great job in explaining this, and hopefully you have found it all very insightful and helpful in how you make decisions around your investments going forward. As mentioned, please do keep an eye out on the email for that post-webinar survey to fill that out. We take that feedback very seriously in how we present and the types of topics that we cover. And yeah, thank you for attending. If you have any more questions, you can always get in touch at info@rivkin.com.au. Our phone number there, 0283023600, or our website, rivkin.com.au. Thank you for joining, and we look forward to seeing you next time.